The Federal Reserve just cut interest rates again, but it's completely different this time, and almost nobody is talking about what it really means. This is gonna affect everything from jobs, mortgages, credit, all the way down to your day-to-day living and how far your money really stretches. That's why we need to talk about the Fed cutting interest rates without any data, but more importantly, how and why we're entering a new money cycle and what that means for inflation, the job market, and even your Robinhood portfolio. Okay, let's start with what actually happened. The Fed recently had a meeting where they made three main decisions. First, they cut interest rates a quarter point. And I know that might not seem like a big difference, but it actually has a huge impact and tells us what the Fed is thinking. See, the Fed has a dual mandate. Basically, their entire job can be boiled down to two main objectives. First, stable prices, pretty much keeping inflation under control. And second, maximum employment. And the lever they have to control these two are raising and lowering interest rates. But by raising interest rates, they help one and hurt the other. And by lowering interest rates, they do the reverse. So their one lever can only help one thing at a time. So they're always trying to balance these two problems. The Fed will cut rates to support the economy growing or when they think employment is starting to slack. And they'll raise rates when they think inflation is the bigger problem and they want it to come down. The second and probably most important thing that they did was ending quantitative tightening, or QT. Now, I know that term seems super complicated, but it's actually easy to understand. Imagine you fill a bathtub with water. The water in the bathtub represents all of the money currently in the economy or in the supply. If the Fed wants to take money or water out of the bathtub, they have to do quantitative tightening. If they want to add water into the bathtub or money to the economy, they do quantitative easing. So QE and QT represent whether the Fed is adding or taking money out of the economy. Now, a lot of people get confused on how this actually works, but here's how it goes down in reality. If the Fed wants to add more money into the economy or more water in the bathtub, they start by literally creating more money. Remember, the Fed doesn't need to raise taxes or sell assets to generate money. They can literally print their own dollars. So the Fed prints money and then needs to get it out into the economy. And they're not standing on the corner handing out $5 bills. Instead, they're going to big banks and buying large amounts of bonds, which are basically debt or IOU notes. And now these big banks have all this cash that they need to generate interest on to eventually pay back the Fed in the future. So they go out and start lending money to you and me at higher interest rates in the form of credit, mortgages, car loans, etc. And that's the basics of how the Fed is able to print money out of thin air and then inject it into the economy through buying bonds. Now, if they want to do the reverse and take money out of the economy, all they have to do is let those bonds, which again are basically just IOU notes, expire. And instead of reinvesting the money into more bonds, they just hold on to them, which effectively deletes it from circulation. That's called QT, or quantitative tightening, and that's what they recently stopped doing. And the third thing that they announced was buying $40 billion in short-term T-bills each month. And if you're following along, you're probably like, okay, well, this is QE, right? Like they're adding more money into the economy. Well, apparently not, because it's only short-term T-bills and they're doing this for reserve management and tax day is coming up and they're not calling it QE, but everyone is calling it QE light or not QE. And regardless of what you want to call it, they've turned off the tightening and they've warmed up the money printer. So does this mean that we're heading towards an easing cycle for sure? Well, maybe. It really depends on a couple things. They made these decisions without any inflation data or the October jobs report. So the next set of data going into 2026 is going to be extremely important. And on top of that, the Fed dot plot only predicts one rate cut in 2026, but it's going to be highly dependent on who the next Fed chair is, because right now, the next Fed candidate is Kevin Hassett, who is extremely dovish, meaning he would like to cut. He's consistently said there's plenty of room to keep cutting, and he strongly agrees with Trump in bringing down rates. Okay, but regardless of whatever happens there, how is this going to impact you? Well, first, we need to look at mortgage rates. Although most people think that the Fed cutting rates will instantly lower mortgage rates, that's actually not the case. Mortgage rates closely follow the 10-year yield, not the Fed funds rate. With that said, mortgage rates could definitely drop, but it's going to take some time. And as for inflation, just because we're cutting rates doesn't mean inflation is gone, as we're still above the Fed's target inflation rate. The real reason the Fed is cutting rates is because of their outlook on the job market. They see it as something that's weakening. And whether that's just a slowdown or because of AI, it seems like it's becoming harder and harder for people to find jobs, especially the younger generation. Now, on the other side, what's going to benefit from these cuts and added liquidity is going to be assets like stocks, real estate, and potentially even crypto. Okay, so how do we prepare for whatever's to come? First, you need to build up your emergency fund and potentially some cash reserves on top of that. We're in an unpredictable time, and just a few weeks ago, the stock market took a tumble. It would have been a great time to be a buyer, so having some extra cash for those dips could be a solid opportunity. Next, start building up cash flowing assets. This could be ETFs, dividend stocks, rental properties, because asset owners will benefit the most from inflation and easing. And I'm not saying to dump your life savings in right now today, but dollar cost averaging is a great strategy. Instead of trying to time the Fed in every decision, just continually invest. And what's going to help you invest even more is to make sure that you're avoiding any type of lifestyle inflation. Just because you start to build up a cash pile on the sides ready for investments doesn't mean that you can go out and spend that on eating out and shopping, even though it's going to be extremely tempting as that cash pile starts to build up. And lastly, the best thing that you can do right now is to increase your skill set. And the entire reason that the Fed is even cutting is because of the weakness in the job market. So even if you have a job right now, you never know how difficult it will be if you potentially lose your job to go out and find a new job in the new job market. This is why I love having some type of side hustle or additional income to not only help you offset your main income, but also help you invest more. And with all that said, there are huge changes coming. We are stopping QT. We are potentially starting QE, but we are definitely entering a new phase. And this isn't happening because we somehow solved inflation, but because the job market just shows as a bigger problem. And the best thing that we can do now is to prepare instead of just sitting around waiting, thinking nothing has changed. Stay invested, stack assets, and don't forget to like and subscribe if you enjoyed the video. Thank you guys so much for watching, and I'll catch you in the next one.